Welcome back. This is part 2 of my interview with David Chapman. And in this section of the 2-part video, we're going to be looking at currencies. And the most interesting thing of this interview, I think you're going to find, is right near the end of our discussion, where David discusses the long-term patterns going quite a way back in time of fiat currencies and regime turnovers and how this all works together within the context of economic and stock market cycles. Hope you enjoy it. That brings up another subject, is the portfolios. Though, I notice you've overlaid gold here, but why don't we're talking Elliott waves. So would you mind if I pulled up, because gold is one of the things you like talking about lately. And just as an aside, I have avoided gold for many years for good reason. It hasn't gone anywhere, but we just started buying at Value Trend, and we're never been, gold bugs or anything, but we have been buying gold this year because probably some of the reasons that you're going to talk about, more, inflation and currency overvaluation. But
currency, yeah.
So let's talk about that. But first, let's go right to the Elliott, and then I can bring up the currency stuff and other charts as you wish. You can see them.
Well, a quick background on my interest in gold was just that on my resume, I spent a number of years running the international money desk at the Canadian Imperial Bank of Commerce, and while running it, a steady buyer and seller of our euro loans was our precious metals desk, which kind of tweaked me. Why do these guys always doing this? So I wound up spending a week or so sitting with the precious metals desk, learning all about their business, and eventually it translated into an interest in the history of gold as money, because the history of gold as money goes back 3,000 years. And there have been periods of experimentation of what we call fiat currencies in the past. And every experiment with fiat currency in the past has failed. And as with most things, they don't fail overnight. And our current experimentation is what dates from August 1971, when the United States of America took the world off of the gold standard, when the US dollar had been convertible as a result of Bretton Woods at the rate of $35 an ounce. A curiosity that most people probably are not aware of was by 1950, Bretton Woods was 1944, by 1950, the United States had the world's largest gold reserves. They had over 20,000 tons of gold. By 1970-71, they were down to 8,000 tons of gold. And the reason was quite simple. Has the US dollar sloshed around the world for two prime reasons. One, the Marshall Plan, and two, the Vietnam War. Central banks of the world kept running to the Federal Reserve and saying, here's my dollars, give me the gold. There was a large claim at $35 an ounce in the late 70s, early 70s, and the United States of America effectively defaulted.
There you go.
How did they do that? They closed the gold window. That was the end of the gold standard and our latest experiment in fiat currencies. Fiat currency is basically the issuance of currency that the government says this is the currency, and it is worth what I say it's worth.
Yeah. During the American Revolution, they were
absolutely. It happened during the U.S. Civil War, and there'd even been periods before that. Historically, people would be curious to know that China was one of the first countries in the world to issue paper money. And that was way back, my memory slipped me here, like 12th, 13th, 14th century, somewhere in there.
Yeah.
And of course, it failed miserably because they printed too many,
Yeah.
and it eventually collapsed upon itself.
Well, that doesn't sound familiar today at all. So,
Well, curiously, and it's not surprising, if one looks at the growth of money since 1971, the growth of money has gone parabolic.
Yeah.
And eventually, I've never seen a parabolic move not collapse. They all seem to collapse historically. So are we going to collapse? Is this the time that we're going to collapse? I don't know. I can't answer that. Very simply, I had labeled this one again. The labels were very obvious. Again, for years, the gold was fixed at $20.69, I believe it was, revalued up during the Great Depression under the Roosevelt administration, which was really just a devaluation of the US dollar, which had gotten very, very expensive at the time. Sound familiar? Because of people rushing to the US dollar out of World War I and various other things. So that peaked and gold went into a nice flat period, basically the $35. And of course, that began to change in the very late 60s when the London Gold Exchange failed, and then there was all sorts of other problems, and it resulted in the 1971 removal of the gold standard completely. Remember, after Bretton Woods, currencies were fixed to the US dollars within trading bands. A few years after 1971, currencies were set to float against each other. And the 1970s was a huge non-confidence in the US dollar as a result of things like the Vietnam War, Watergate, et cetera, et cetera, et cetera. And the US dollar went steadily down. And what did gold do? It exploded to the upside. Now that it was free to trade rather than being fixed to the US dollar. That peaked in 1980, which is wave 5 there, and then followed a rather grinding, steep, frustrating for the gold bugs 20+ year correction that bottomed in 2001, and then gold started to rise again. And the prime reason gold started to rise again was actually, again, currency problems. There was currency problems with the US dollar, again, US invasions in out of 9/11, Afghanistan, Iraq. I could go on, and there was confidence was being lost in the US dollar. And eventually that peaked in 2011. And then we went into a correction. But if the major correction was that big ABC from 1980 to, I think the final bottom was 2001, what we've been going through over the past little while is actually was the wave 2 of a new 5-wave up. So we're actually, I think, still in the early stages of wave 3 up, which is, if you'll notice that from wave 2 down here at the bottom in 70, 71 to wave 3 here in 1974, that was quite a sharp move. So while we're going through a correction right now, I don't think it's going to be a devastating correction, and it should eventually result in a new big up move.
Similar to the move that took us into early 70s.
Exactly, and it has a result of current currency wars that have been ongoing probably really since the last decade. It's quite fascinating in that the US dollar has been very, very strong, and for good reason. You got a war over in Europe, and countries like Japan got low inflation, so they don't raise their interest rates. There's been some shakedowns and lockdowns and all sorts of problems in China, and the result has been there's been a lot of capital flow out of those countries where do they go? They don't go to gold, they go to the US dollar.
Flight to safety.
Yeah, yeah. I mean, the US dollar is viewed as the flight to safety. The result is the US dollar keeps going up. But that in itself is causing a problem in that you've got all these currencies now falling, and it's been requiring, we've been reading constant stories lately of central bank interventions, the worst one being over in the United Kingdom, where the Bank of England has been on intervention almost on a daily basis in order to save the pound from collapsing into, I don't know what, oblivion, I guess.
So on that subject of currencies, you've given me a couple of charts, and David, can you see my screen here? There's
Yep.
this. I know this is a currency chart you did.
Yeah,
send me.
that's a big, really big picture. This is the other one. The chart of the other currencies here. The more current one is the current situation.
So would you like me to pull up one?
Yeah, pull up that one. Yeah, pull that one up first. Yep,
Okay,
yep.
so let's go with that.
We'll just have a quick look at that one. I can't show everybody's currency, but if I could, the picture would be the same. Gold and other currencies has broken out, has been up at or near all-time highs. The two best ones there are the Japanese yen, which is the fourth one down, and the British pounds. They are not far off their all-time highs. In fact, the pound, who knows, it might even be making new highs. But if you look at the bottom, I got it gold in US dollars, and it's just been in a steady downtrend. It hasn't even broken out. When the gold in US dollars breaks out and starts rising in all currencies, then we're going to have the big move.
Yeah.
And I'm not quite sure what's going to trigger it, because the US dollar is causing a problem. Too many countries, too many sovereign countries and corporations have borrowed their home currency. The result is they have to pay back increasingly expensive US dollars, but their earnings are in their home currency. So let's use the Japanese yen as an example. If they borrowed in US dollars, they're constantly now having to pay back more and more US dollars, and with depleting yen. So it's a problem for them, and it's going to be a problem for the earnings season, because the multinational corporations of the United States, the bulk of their earnings are in foreign countries. So they're going to be in foreign currencies, which they got to translate back to US dollars, and they're going to get a lot fewer US dollars than they used to get. So we got two potential explosions coming here: lower earnings, which is going to lower the stock market probably further, and we got sharply rising currencies and currency wars effectively going on, because it almost comes like a race to the bottom. Because yeah, it helps their exports, but it boy, does it make those imports more expensive, especially oil.
I should just mention before we go to the next chart, these charts are not actually the currency. This is gold versus the currency. So
yeah, no, well, all I've done is I expressed gold in Canadian dollars. I expressed gold in euros, expressed it in pounds, expressed it in yen, and of course the one at the bottom, because the US dollar is the world's reserve currency. So everybody thinks of all commodities in US dollars. That's the way they quote it. I mean, if I put up a chart of the S&P 500 in one of these foreign currencies, it would look a lot better than it does in US dollars.
Yes, yes, right. Yeah.
They'd still be losing money, but not at the same rate. In other words, it has fallen because their currency has devalued. So the fact that the S&P 500 is in US dollars means that in their own currency, it's more valuable.
Absolutely. Absolutely. So
So
should I bring this one up next?
yeah, this is a really long-term one, and one I used in a money show here a few years back when I was trying to trace that a reserve currency does not last forever. And I always like to think of the first reserve currencies that were noticeable, were really going back to ancient history. For a couple of centuries or so, the Greeks issued a beautiful silver coin with an owl on it. It was known as the Athena owl, and it was the currency of choice for trade back in, well, the Greek Empire was what, 300 BC, 400 BC, somewhere in there, 400, 300, 200 BC, somewhere in there. Eventually, they were replaced by the Roman Empire, and their currency, the one that was widely used in trade, was the Roman denarii. Well, like all currencies, even back then, those currencies eventually collapsed. The Roman Empire, in particular, it almost sounds just like a repetitive one of those repeating things that just goes on and on and on and on. Wars, foreign wars, and eventually they started devaluing the denarii by cutting the amount of silver in it. Had the same effect as printing a lot more money, till eventually it came to the point in the late 5th century, I guess it was, that whatever the government of the day in the Roman Empire was issuing, nobody even wanted it. It was just junk. And out of that rose at the time what became a currency at the time was the gold dinar, or gold, the gold solidus, it was called, in the late 4th and 5th century, and into what was known as the Byzantine period after the Roman Empire broke up, which was basically Eastern Rome, and then that saw the rise of the Arab states, which, if people don't remember their history, ruled all of Southern Europe from about 700 AD to about 1400 AD. But eventually those saw the rise of other powers, and
that's what's on this chart here.
And that's what's on this chart. And one of the first ones actually was a Venetian dinar, but eventually it became replaced by the Portuguese one. The Portuguese were huge traders. Their currency became widely recognized and was used extensively around the world for about a century or so. And has all of these show, there's a huge lead-in period where the currency's there, but it's not the dominant currency. Eventually they become the dominant currency, but eventually they get challenged. Their empire gets defeated in a war, and another guy rises. And of course, the next one was Spain, who ruled roughly until almost the 17th century, till they were defeated initially by, well, it was a combination of the British and the French, but the one that really rose to prominence was the Dutch guilder. And they had their period that lasted well into the 18th century. And again, wars broke the guilder. They lost the wars. They lost it against France, they lost it against Britain. And the Dutch guilder disappeared into the sunset to be replaced by the French franc, which lasted basically as a global currency until 1815, which, if people know their history, was a rather deadly day for France when they lost the Battle of Waterloo, and the prominence rose to the British Empire. And the British Empire, pound sterling, dominated for the next 100 years. And again, wars and challenges. There's always a challenger to every one of these. Portugal was defeated by Spain, Spain by the Dutch, Dutch by the British and the French, French by the British, and it wasn't the Americans who defeated the British. Their challenger at the time was the growing German Empire, which I say is China today. Some may disagree, but today it's China that is challenging the dominance of the US currency as the global hegemon. While the US reserve currency remains probably at least 60% in central banks' portfolios, has their reserve currency. They do have other currency. The yuan has been growing, but it is still not dominant. And
that's actually an amazing chart. I mean, I'm actually probably going to put that on my blog at some point. If you don't mind, I'll credit you with it.
Well, I guess it was probably a better lead in the when I did that thing for the Money Show a couple of years ago called a reserve currency does not last forever. So yeah. that kind of leads us in to the period of the dominance of the US dollar, which has been the dominant currency since 1944 and Bretton Woods. But it was also rising out of World War I because the British took a beating. Yeah, they won the war, but took a beating. Yeah, you know what I mean. That's right. And by the end of World War II, they were beaten, and by the 1950s and 60s, the old British Empire is falling apart at a rapid pace. Yeah. So today we have the American Empire, although many people claim that, oh, how can it be the American Empire? Well, I always say, well, they have 800 military bases all around the world, and that and if you go and check what China and Russia have in military bases around the world, it's puny. It's nothing. So, yeah, the United States of America is the global hegemon. The major world institutions, IMF, World Bank, SWIFT, are all dominated by the United States of America. And that's why, led by China, again, in combination with Russia, they have been trying to build their own IMF, build their own World Bank, build their own SWIFT system to get out from under the dominance of the US dollar. And in all previous cases, the dominant economic power, in this case US, had to somehow destroy the challenger.
There you go.
So today we face, America faces China and Russia, and how do they destroy them? Without destroying us all.
Yes, because they have those nuclear things, don't they?
Yes, yeah, those little nukes that both China and Russia.
I mean, even Putin's talking about using the smaller nuclear weapons, not the more tactical. Okay, let's use the tactical, well, not the real ones. You know,
something people never pay attention to, but there were other reasons behind the American invasions of Iraq and Libya that were lost in the dust of bombs dropping. And one was Iraq had made it crystal clear, because they were being challenged by the United States at the time, made it crystal clear that they would no longer accept US dollars. They would only accept euros or other currencies for payment for their oil. The US slapped them down with an invasion. Libya was the same thing. Mr. Gaddafi was trying to form a Pan-African group of countries that was going to use the gold dinar as the current dominant currency. Again, a challenge to the dominance of the US dollar at that time. Take out Gaddafi. They took, I mean, I'm not saying Gaddafi and Saddam Hussein are good people, don't get me wrong. I'm merely pointing out the fact that currency wars were actually behind the invasions. But that's not what the public was told, of course, because I mean, who are you going to tell them we're going to invade Iraq because they're going to use the euro instead of the US dollar? I don't think that would go over very well. No. Anyway, and the challenge today is the growing use of the yuan, particularly throughout Asia, and and trade wars. It's amazing that trade wars are at the center of this, because leading up to World War I, there were trade wars and currency wars. Leading up to World War II, there were trade wars and currency wars. And here we are again. We've had trade wars. A member of the that under the administration of Trump, they put all sorts of tariffs on China, and there was retaliation, and even the tariffs put on Canada, and Canada had to retaliate, Pete's sake. The other side of it is that sanctions are really just another form of trade wars, and the country that is being sanctioned will find all sorts of ways to get around them.
Absolutely.
So,
David,
anyway.
We probably have to wrap it up because
they're fascinating subjects.
It is. I mean,
and they're too long.
We should do almost like a 3-part video series on the history of money and the markets.
There's probably better guys than me out there that have really studied this stuff. But anyway.
Well, it's amazing stuff, David. And what I'm going to do is not on the video right now because we are running out of time, but I'm going to get you to maybe shoot me a list of recommended reading material for readers that are interested in the subject of, the history of currencies and some. Well, we could talk about the fourth turn we already mentioned, but those of reading materials that you might recommend people read to sort of expand their knowledge.
Well, it's basically reading about history.
Yeah.
So
amazing stuff. My dad was a historian, so
I always say, well, history doesn't repeat itself, but it does rhyme.
It rhymes. That's right. Well, David, this has been a very fascinating interview, and it's been very different from many of the other interviews I've done. So, I think our watchers are really going to enjoy.
I hope they enjoy it, and. Am I allowed to say I'm at www.enrichedinvesting.com?
Yeah, you could say, yeah. Well, you just did. So David's on the board of directors for Enriched Investing. So he, I'll get you, as I said, to shoot me a list of reading material and whatnot, and I'll put in a link.
I'll have to look.
Well, anything that comes to your mind, but I'll also put a link to your contact. So. Thank you, David, and we'll keep on communicating. And I every once in a while I quote your work, so it's been amazing to have you on. So
Keith's been a slice. Where are you located?
I'm in Barrie, Ontario. Not exactly a metropolitan, but we get it done.
Oh, maybe there's somewhere halfway for have a beer.
Absolutely, that'd be great. Well, thanks, David.